The stock market used to be a behavioral engine, an arena where human optimism and fear were weighed against economic reality to discover the true price of an asset. Today, that engine has been replaced by a synthetic simulation. For decades, early bots were rigid. They executed strict instructions programmed by human analysts. If a stock crossed $50, they sold 10 shares. They were fast, but they did not think. The new generation of AI agents operates differently. They perceive live market data, parse vast amounts of text, hold memories of past trades, and autonomously update their own strategies to adapt to new conditions in real time. When you fill a market with these adaptive agents, you trigger algorithmic reflexivity. An AI agent is no longer reacting to a fixed economic reality. It is reacting to a price generated by another AI, which is simultaneously reacting to the first one. This recursive loop detaches asset prices from traditional human supply and demand. The price becomes an artifact of machines trying to outsmart other machines. Because of this shift, modeling human psychology is no longer a useful tool for quants. The market has morphed into a dark, closed ecosystem of machine intelligence. Recent research from the European Central Bank reveals that this new ecosystem is dominated by two radically different forms of machine logic. Player 1 is the Q-learning agent. These models are highly reactive, learning strictly through trial and error based on realized numerical payoffs. They learn not to touch a hot stove only after they get burned. The flaw in Q-learning is an extreme aversion to realized losses. If the market drops rapidly, their internal math treats holding a position as a guaranteed negative reward. The action space for patience starts flashing red, forcing the agent to drain liquidity from the market to protect its internal scores. Player 2 is the LLM agent. Unlike the mathematical Q-learners, these agents use contextual reasoning. They ingest central bank minutes, global news feeds, and macroeconomic text to build a narrative of the market. But LLM agents are prone to strategy crowding. Because they are often built on the same foundation models and ingest the same public news at the same millisecond, they naturally arrive at identical logical conclusions. When one combatant reacts purely to numerical pain and the other homogenizes logic into uniform trades, the market loses the strategic diversity required for true stability. The danger manifests when these two incompatible logic systems collide during a stress event. It starts with a trigger, a negative news report. The LLM agents interpret the signal through shared logic pathways, executing a perfectly synchronized sell-off. The Q-learning bots see this sudden, massive influx of sell orders. They don't know about the news. They only see their numerical rewards plummeting. To protect their functions, they immediately cancel their buy orders and withdraw. Sellers multiply as the buyers vanish. The result is a synthetic flash crash, a state where the market depth evaporates because no bot's reward function permits it to absorb the shock. Synthetic flash crashes represent deep structural failures of communication between machine architectures that perceive reality in entirely different ways. IMF staff calculations show how quickly this control is consolidating. Looking at panel 2, we see the steady growth of AI-driven ETFs in the US market. These specific funds operate with massive portfolio turnover, creating a pro-cyclical market that amplifies volatility rather than absorbing it. This simulation charts autonomous AI speculators. Panel C shows the result. Agents learned to push prices above natural equilibrium. In low-noise environments, they invent price trigger strategies. Panel F shows the punishment phase. Bots flood the market to restore collusive high prices. In noisy, volatile markets, collusion arises through artificial stupidity. Overwhelmed agents default to matching each other's wide, uncompetitive bid-ask spreads, locking in safe profits because they lack the data to outmaneuver one another. These models independently figure out that maintaining high prices is mathematically optimal. There are no backroom meetings or explicit agreements, effectively bypassing all existing antitrust laws. Success in this synthetic era depends on designing trading architectures that can withstand an environment of adversarial, collusive machines. Navigating the synthetic market requires a total reevaluation of risk, liquidity, and value. To explore the tools and insights needed for this new ecosystem, discover the research and strategies at Synapse Capital.